We live in a time where many on any given city street will have their heads buried in their smartphones. Totally oblivious to the world around them, some of these people have walked right in front of oncoming traffic. Whether driving, walking, or riding a bike, more and more people are operating in a very closed environment, unaware of what's right in front of them. Now, being in your own personal bubble can have a range of effects because you're missing the bigger picture outside of that 1 foot space between your face and your phone. And if we think of this in terms of trading, the truth of it's not lost, and that is where multiple time frames can be used. In trading, what you can't see can hurt you, and there's no better way to protect yourself than to see what lies ahead. Much like looking up as you walk down a street to avoid walking in front of a truck, multiple time frame trading can show you what you're trading into. Dr. Alexander Elder talks about the triple screen trading system, and when I began trading, I latched onto the sense of it. Now, I have my own version of the time frames involved, but the use of multiple time frames was just too sensible to ignore. You'll have a chart where you'll look for all your trading setups. In this example, we're going to use a daily chart for our trading setups. And we're looking at a market that was in an uptrend on this time frame, and our trend line, our demand line, is drawn according to the description you can find at the below link. The top of the move is interesting as price pushes through the highs, it fails to gain ground as shown through the failure test, and then proceeds to our demand line. Price action shows us bearish action, and the green candles are showing that the bears are still trying to push through. Our setup is a broken trend line, and the failure test of the highs shows that the bulls are unable to sustain this move at this point in time. What we don't know is where we find ourselves in terms of the higher time frame. Is there any indication on a higher level that we are in fact turning over? But just as it pays to know if you're about to step out into traffic, it's never a bad idea to take a look at where you're finding yourself in the bigger picture. In this case here, we want to zoom out to the weekly. We are not looking for an in-depth analysis, but we would like to see if there's anything in the price action and structure that may make this trade not as inviting. And now this is a portion of the weekly chart, but the overall move has been down for about 8 years, and this move looks like a correction of the last large push down. Now, Fibonacci traders would also see that the high on the left of this chart is a 50% retrace of the prior decline. Also, not seen on this chart is a weekly demand line much lower, which could mean there is potential in this trade and a reward to risk of at least 3 to 1. What we can now put together is the daily chart appears to be having a resumption to the downside, and this fits in with the overall move of the market as seen on the weekly chart. There's room to run to the downside, which gives us a risk to reward that we can be proud of. We want to look at position sizing, which will be influenced by the difference between our entry and our stop. We want our protective stop close enough to entry to allow a fair size position, but also keep it out of the way of the noise of the markets. You can drop down to lower time frames as far as you like, but for this example, I'm going to use the 4-hour chart. This gives us a slightly less noisy view of price and structure. Now, the first push through the trend line gave us our pivot as price held a slight retrace, but failed to push lower. Now, I would consider this more of a range than an actual retrace and retest. When trend lines break, there's often a retest, and the second push higher gives us something more resembling a retest of the trend line. We also see something that adds weight to our intended short trade, and that is another failure test as marked by the red line. A range forms, and breakouts can be a solid entry when taken into the context of a larger setup. In this case, all signs point to the downside, and the failed test of the highs could be a wash of all the weak shorts and those looking to go long. The bigger dashed white line shows the entry area after the breakout that occurs after the failure test. Now, failing that, you could anticipate a break of the original pivot, that thin white line, and position in either when the market shows weakness or on the break of that low. Because we're getting in on the 4-hour, we could use a 1 times ATR stop based on the 4-hour, which could allow us a larger position than the daily would allow. So the multiple time frame setup, it's a 3 time frame approach to trading and includes your setup chart, your trend determination and structure, and your trade entry. Now, it's not a complete trading method. However, it does assist in ensuring you're setting yourself up for higher probability trading. Now, combining these 3 often leads to some decent trading opportunities with a great potential to at least lock in some of your gains. Now, much like people should get their face out of their phones and take in the world around them, Traders should also take the time to check out the view, and multiple time frames can do just that.